Fed credibility is suddenly at the center of the equity story, with long-term yields testing levels last seen before the global financial crisis, just as big tech tries to stabilize risk appetite. You are watching vTalkInsight, Equity Pulse Daily for July 31st, 2026. Let us start with how the new rate and curve regime is reshaping equity risk and leadership. The clearest macro signal for equities right now is a sharp bear steepening of the U.S. yield curve driven by doubts about the Federal Reserve. The latest press conference undermined policy credibility in the market's eyes, pushing the dollar lower while long-dated Treasury yields surged, with the 30-year bond around 5.2%, its highest level since 2007. Markets are pricing less at the very front end, but demanding much more term premium at the long end, a combination that reflects anxiety over the Fed's ability and willingness to contain inflation. Under the surface, rate expectations have become more volatile as the Fed steps back from explicit forward guidance and leans harder into data dependence. Implied probabilities now put roughly a 2/3 to 70% chance on a September hike, with some pricing suggesting the possibility of several moves over coming meetings and a full hike effectively baked in by October. At the same time, the very front end briefly rallied after cooler than expected inflation data and a press conference that sounded more dovish than the vote, underscoring just how confused the policy signal has become. This rates backdrop is feeding directly into equity volatility and valuation tension. The S&P 500 has whipsawed, selling off hard as long yields spiked, then staging a sharp rebound, while the volatility index moved above 20 before easing back into the high teens, pointing to choppy rather than panicked conditions. Higher real long-term yields raise the discount rate on future cash flows, putting particular pressure on long-duration growth sectors that had benefited from ultra-low rates, even if headline indices can still be supported by a handful of mega-caps. For credit markets, the bear steepening is a double-edged sword. Aggregate bond indices now yield around 5% and many corporates near 6%, which looks compelling in real terms, but the move has been driven by long and volatility, heavy fiscal deficits, and crowding out from massive data center funding needs. Longer duration credit is increasingly exposed, and several insights flag the risk that if long-term yields become unanchored, the combination of higher borrowing costs and tighter liquidity could trigger a broader risk-off event across equities, credit, and emerging markets. Inflation data are sending mixed messages, which matters enormously for how equities interpret the recent rates move. On one hand, core personal consumption expenditures inflation rose just 0.1% month-on-month, the lowest since early 2025, and year-on-year core eased to about 3.3%. With recent PCE reports even showing a negative headline print. Those numbers support the case that underlying price pressures are cooling and reduce immediate pressure on the Fed to tighten aggressively. On the other hand, the margin for error on inflation remains slim. Roughly 39% of the consumer price basket is still running above 3%, especially in essentials such as food, electricity, and rent, while new Section 301 tariffs, strong fiscal stimulus, and robust demand are all adding upside risk. Several insights suggest markets are therefore demanding a higher inflation risk premium, even as some forward indicators point to further disinflation later in the year. Energy is amplifying that tension. U.S. commercial oil inventories are at their lowest since 2018, and the Strategic Petroleum Reserve is at its lowest since 1980. Just as refining runs at above full capacity have driven gasoline and diesel stocks to multi-year lows. Attacks on Russian infrastructure, a halt in Russian diesel exports, and escalating conflict in the Middle East, including strikes on LNG tankers and constrained shipping through the Strait of Hormuz, are all supporting Brent crude prices above $90 and keeping refined product markets extremely tight. For equities, that energy and geopolitical mix pushes in different directions across sectors. Integrated producers such as Shell are printing strong numbers, with second quarter profits well ahead of expectations, record performance across upstream, refining, and gas, and new share buybacks underpinned by very high refining margins. Yet higher fuel costs and shipping disruptions threaten margins and demand in more vulnerable areas like transport, tourism, and parts of consumer discretionary, and they complicate the inflation outlook that already has markets questioning central bank resolve. Index-level equity moves mask a striking divergence in leadership. Much of the recent strength in the S&P 500 has been driven by Microsoft, whose record single-day gain in market value contrasts with the majority of index members finishing flat or lower on the same sessions. That kind of concentration leaves the index vulnerable, especially when the Nasdaq 100 has already fallen about 11% from its June high, entering correction territory before stabilizing on the back of big tech earnings. Outside those mega caps, the picture is more resilient than U.S. index levels alone suggest. Equal-weighted indices and European equities remain close to all-time highs despite volatility in technology and semiconductors, indicating that leadership has broadened away from pure momentum trades. The Philadelphia Semiconductor Index, for example, just saw its biggest one-day rally since early 2025 after a brutal month in which it still sits roughly 20% lower, highlighting both the damage in crowded trades and the potential for sharp tactical reversals. Europe is quietly emerging as an important pillar in that rotation. Analysts are revising European earnings higher, with forecasts for more than 20% cumulative earnings growth between 2026 and 2027, supported by improving manufacturing purchasing manager indices and a narrative shift toward recovery. London, in particular, has not fully participated in the speculative rallies seen in the United States and Korea, yet the FTSE has reached record highs. The IPO pipeline is the strongest since the financial crisis, and the exchange is rolling out round-the-clock trading for some products to attract global flows. Within Europe, country and stock selection remain crucial. French equities are outperforming on days when the broader continent is flat or down, helped by strength in construction, materials, and selected consumer names, while Germany still grapples with weaker industrial demand. Company results highlight that divide. L'Oréal is beating expectations across divisions thanks to broad-based beauty demand and a diversified geographic footprint, while Adidas has sold off despite strong top-line delivery as heavy World Cup-related marketing spend raises new questions about profitability. The most consequential bottom-up story for global equities remains the clash between different big tech approaches to AI and cloud spending. Microsoft's latest quarter was a clear positive surprise, with Azure revenue growing 43% year-on-year and guidance lifted to 45%, all while generating more than $20 billion of free cash flow. Investors rewarded the combination of rapid AI-driven growth, pricing power across the enterprise stack, and more manageable capital intensity, driving Microsoft shares up roughly 8.5% and helping to stabilize the broader tech complex. Amazon Web Services is telling a similar story of profitable scale. AWS delivered 37% revenue growth with better-than-expected margins and has secured multi-year agreements with leading AI labs that commit at least $100 billion of future cloud spend. Amazon's in-house chip and AI businesses have each reached a $25 billion annual revenue run rate, and proprietary silicon such as the Trainium line may allow it to lower cost per token versus rivals that rely entirely on third-party hardware. By contrast, Meta is seeing investors push back hard on an aggressive but opaque AI investment plan. The company is guiding to several years of negative free cash flow as it pours capital into compute and infrastructure without yet providing clear revenue projections or a defined platform strategy, leading to valuation pressure and a near double-digit pre-market drop after earnings. Apple continues to post robust hardware results, with guidance for up to 17% revenue growth, strong iPhone sales, and plans for a very high-priced foldable device, but part of the recent rally appears driven by its status as a perceived AI safe haven rather than tangible new AI products, raising questions about stretched multiples. The semiconductor complex illustrates how crowded AI trades can cut both ways. Samsung just reported a 250-fold increase in chip profits, yet the stock fell as investors questioned the sustainability of memory pricing, worried about ongoing supply-demand imbalances, and looked over their shoulders at rising Chinese competition. Memory shortages and elevated component costs are expected to persist for 1.5 to 2 years, pressuring margins for major buyers, while companies such as Qualcomm and ARM are already citing smartphone weakness and softer royalty growth even as data center demand holds up. Credit markets are reinforcing that equity discrimination within tech. Spreads for riskier technology and AI-related borrowers are widening, with notable weakness in names like CoreWeave, and investors demanding stronger covenants, just as aggregate AI and data center infrastructure spending is projected to reach roughly $1.25 trillion next year. The message across both debt and equity markets is that cash-generative AI strategies with visible returns, like those at Microsoft and Amazon, are still being rewarded, while highly leveraged or opaque capex stories are facing a higher cost of capital and less benefit of the doubt. Moving away from megacaps, several companies are offering a useful read on the underlying economy. Starbucks continues to see broad-based strength, with increased foot traffic and higher average ticket sizes driven more by product mix and food attachment than by simple price hikes. Its store revamp program, costing about $150,000 per location without requiring closures, is already boosting throughput and will be accelerated through 2027, while an improving balance sheet gives management room to fund remodels, new stores, and potential capital returns. Elsewhere in consumer and services, the signals are more nuanced. Jersey Mike's is planning aggressive global expansion after a heavily oversubscribed IPO, and fashion brand Reformation expects to maintain double-digit EBITDA margins as it doubles its store base, both pointing to confidence in experiential and niche retail demand. At the same time, Norwegian Cruise Line has cut guidance and seen its shares fall sharply on softer bookings and Middle East-related disruptions, reminding markets that higher energy costs and geopolitical risk can still bite travel and leisure names. Financials, industrials, and commodity producers are also contributing to a more balanced equity backdrop. Lloyds Banking Group delivered a 14% year-on-year profit increase, raised its dividend by 30%, announced a £1 billion buyback, and laid out a plan for mid-single-digit annual revenue growth out to 2030 as it diversifies away from pure interest income and deploys generative AI to deliver around £100 million of annualized benefits. On the industrial side, Heidelberg Materials is seeing organic volume growth for the first time in years, helped by data center and infrastructure projects, while Logistics Group XPO has pushed operating margins above 20% on accelerating freight volumes, with customers turning more optimistic about manufacturing demand into the second half. In resources, long-cycle themes are increasingly tied to both the energy transition and AI infrastructure. Anglo American's profits and higher dividend are being driven by record copper prices, with management highlighting that electrification and data center build-out are now major demand drivers alongside traditional uses. Shell not only beat earnings expectations, but also reiterated a long-term bullish view on liquefied natural gas, projecting roughly 65% global demand growth by 2050, and is aligning capital allocation around that outlook even as short-term geopolitical risk keeps energy markets volatile. Pulling this together, equities are trading in the cross-currents of a Fed credibility shock, a powerful repricing at the long end of the curve, and a mixed inflation picture that is being complicated by energy supply tightness and geopolitical risk. Index performance is increasingly driven by a narrow group of AI and cloud leaders such as Microsoft and Amazon, while the broader market shows more resilience in European cyclicals, banks, industrials, and select consumer franchises that benefit from solid demand and stronger balance sheets. At the same time, credit markets are rewarding cash-generative strategies and punishing opaque, highly leveraged capex plans, especially in the more speculative corners of the AI ecosystem. From here, the key signals to watch are long-term Treasury yields, upcoming labor and inflation data, developments in the Middle East energy corridor, and whether earnings revisions in Europe and quality cyclicals can continue to offset pressure on the more crowded parts of tech. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.